Good morning and Happy New Year. It's the first trading day of 2025. I'm sure you know that, but for prosperity's sake, I say that in the video. And this is the Zero DTE morning market analysis, where we look at what the market situation is for our daily Zero DTE trades. If you're a watcher of this, you know that we specialize in putting on out-of-the-money butterflies, asymmetric trades, looking to minimize our risk and maximize the return on the capital we put to work. And every morning, what we do is do a situational analysis where we're looking at volatility, big picture, as well as the implied volatility for that morning and how the market is pricing options and what that implies in terms of how much we want to risk or expose ourselves to that market, and what direction we're going in, and what is the specific setup based on the current market structure. And today, we're going to focus a little bit on volatility and talk about what I call the Goldilocks Zone. And, well, that's what we're showing right here. I thought, oh my God, I really should have started off with, hey, here I am, right? But yeah, we're going to focus on the Goldilocks Zone. And every morning, like I said, we look at volatility. Let's take a look at that again. We're looking at the VIX, big picture, and you see it's crazy annotated, and that's because we use all this. This is kind of our guide for what trade that we're going to put on. Like I said, we primarily focus on out-of-the-money butterflies, and that is our standard trade. We have to figure out what size butterfly and how far out of the money it's going to be and all that other stuff. And we choose a particular asymmetric trade, usually a risk to reward of 1 to 9 to 1 to 15. And sometimes there are edge case trades that occur based on where volatility is, where the market is. And that will compel us to trade other things that come into play because of that, so that we can fully take advantage of the rate of premium decay. And the most basic assessment is, well, where is the volatility regime? And I've broken up volatility into three major regimes: low, medium, and high, or Zombieland, Goldilocks, and chaos. Now, when we get into Goldilocks, that's a VIX on the S&P 500, anywhere from 17 to 32. The reason why it's called Goldilocks is because it's just right. That's an area when we're trading, it seems that our trades become alive and become more fruitful. We can expand our exposure to that volatility. It's like walking into the fire and then deriving power from it. When we go into the Zombieland, well, it feels like we're being chased by zombies and running through mud. We're in chaos zone. Those are fleeting moments when volatility spikes. And you would think, oh, well, that must be super hard, but it really isn't. In fact, I like chaos zone way more than Zombieland. Unfortunately, we spend a lot of time in Zombieland, so we have to risk adjust. That doesn't mean you can't make money in Zombieland. You certainly can. It's just that Goldilocks zone is so much better. And we're starting off the new year slightly into Goldilocks zone with the VIX sitting at 17.8 or 17.18 or 17.1, just above it, just barely above it, but that's good enough. Now, the way we use this chart is we're trying to figure out, well, what range of butterfly widths are we going to choose today? And you can see over here on the left-hand side, let me illustrate that. Right over here are the widths, and you can clearly see that they are aligning with the level that we're at. And they're color-coded, by the way. They're color-coded because there is a second determination that we make for more localized volatility for how the market is pricing options that morning, and we'll get into that in a second. But because we're at 17 or a little bit above 17, we start getting above here into this yellow area, 20 to 30 wide. So we're looking at butterflies, out-of-the-money butterflies that are 20 to 30 wide. Now you see that it's a range because it's not the market doesn't go in chunks. It's sort of this spectrum of results, a continuously improving or evolving market. So we choose a range. Now we need to know, well, what end of that range should we be on? Should we be on the low side, the narrow side, or the wider side, the 30 side? And so then we do a second volatility assessment, and that's by looking at what we call the big ass fly, which is an at-the-money 50-wide fly, and you can do it either with the ES or the SPX, depending on what your platform will support, but they'll both give you approximately the same result. And we want to look at a long 50-wide butterfly at the money in the morning before economic reports come out. Now, what are the economic reports that are coming out this morning? Well, let's take a look. So we can see that this morning, Thursday, January 2nd, we have unemployment claims, which is one of the more impactful reports. So, and I'll show you why we're looking at this, because it's going to be important for when we look at the big ass fly. We have final manufacturing PMI, which is a midline potential impact, and crude oil inventories, which usually comes on Wednesday, but because Wednesday was New Year's Day, it was a holiday, they pushed it off until today. Now, all of those have the potential for adding energy or volatility into the market, particularly unemployment claims, because I think that's a sore spot or a area of interest or a prime directive from the FOMC or the Fed, the Federal Reserve, as they are hyper-focused on two things: stability of markets and maximum employment. And unemployment has been rising steadily for the last year. And so if there is an off number there, that could cause a lot of volatility coming into the market. If it's within line, it depends then on what the underlying numbers are rather than just the front line number. And so it happens at 8:30. That's an important thing. That's well before the market. All these other things are happening after the market opens. So that's where the big ass fly comes in. All right, so let's get back to the big ass fly. All right. And so, as I said, we're first trying to determine how wide we're going, and that's 20 to 30 wide. We want to know, well, should we be on the narrower end or wider end? And that's where the big ass fly comes in. And so up here, you can see we have another chart or guideline that will tell us, well, where should we be on that range? And you can see it's all color-coded. So we're 30 to 20 wide, and that's that yellow. So we come up here to Goldilocks 1, and you can see 20 to 30 wide. And then there's this scale up here. That scale is showing you the debit of that 50 wide at the money fly in the morning. And I've seen it range anywhere from 5, as low as 5. That's super volatile in the morning. And as high as 35, and that means it's super not volatile, deep into Zombieland, and really nothing's going on. And when it's a debit that's very small, that's telling us that the pricing on that fly is really advantageous. When it's really large, that means there's really not much opportunity. So the first way we use this big ass fly is to determine how wide we're going to, or what end of the scale that we're going on. So that's the first thing. And if it's below a certain number, this number 25, then it starts becoming a trade in its own right. So we use the out of the money super wide, 50 wide fly first as an indicator to help us judge how options are being priced that morning. And secondly, if it is below a certain number, 25, a debit of 25, then it starts becoming an attractive trade. And the reason for that is that now we have enough profit potential for that day and low enough gamma risk that it makes it a good risk. And of course, the lower it will go, the better the risk it is. All right, so that's why we look at the big ass fly. So let's go take a look at that big ass fly and see where it is. So we go to Thinkorswim, And we can see that that 50 wide fly this morning, right now, is definitely below 25. It's at 22 and change, or 23 and change. Well, it's jumping around, 23 and change. So definitely below. So it's a candidate for taking that fly, but more importantly, we want to look at that number. Let's call it 23. It looks like it's jumping between 22.85 and 23.30, something like that. So it has a little bit of a spread on it. But that now is a trade that we would be very interested in taking. And the reason for that, one of the first opportunities by taking that trade is after that unemployment report is released. Volatility tends to rise right into these type of reports, and then right after the report is released, you'll get a rather sharp drop in that implied volatility, and that, in fact, will cause an acceleration of the premium decay in our options trade. And so what will happen is, if you're in that fly, you'll get an almost immediate bump up in the value of your trade. In other words, you'll make money almost immediately. And we put a stop on that of $3.50. So if it doesn't work out for us, that usually means that price after that report move way out here somewhere, and so we'll get out. But as long as it stays inside of the tent of that fly, we'll stick with the trade. So that's the big ass fly. So let's go back, knowing what it is now, and go back to our VIX chart. And we can see that 22 is right in the middle. So we won't use 20, we won't use 30, we'll use a 25 wide fly. That is more or less optimum for this morning. So any additional trade that we put on today will be a 25 wide out of the money butterfly. So the next thing we do is we look at where the market's trending. And we can look at that on a daily chart. We can see that our moving average is sloping down and we're below that moving average. So in general, our bias is down. So we'll probably be looking at put flies out of the money. I mean, that's a tough thing to call at the beginning of the year. You know, you're thinking, man, we want that beginning of the year to move up. Is it because it's the first trading day? Markets will be excited and they'll want to move up, or will they move down? I've seen both situations. Usually depends on that very first week of trading, where the market ends up, where the market then starts developing its own internal bias on how the year will go. But that first day can be anything. Not everybody has come back from vacation yet, so there's definitely going to be lower volatility or lower liquidity, but maybe higher volatility. But we'll start with a put out of the money put fly. The next thing to look for is market structure. And the market structure is determined by the volume profile. And what we want to do with the volume profile is make sure we get enough profile in so that we can see the entire profile. So we can see it here. See the entire profile. Market structure will tell us where support and resistance is, which will be on the edges of these nodes. This is volume at price levels. The edges of those nodes and these deep crevices will all point those out. So what I do is I mark that up to identify where the nodes are and where those deep crevices are. Right? So when we zoom into the daily chart or a daily view, once we've zoomed in, we don't really need the profile anymore because we've marked it up. We can tell where those nodes are and where those deep crevices are, and you'll see very plainly that the market pays attention to where those points are, like here and here and here at the bottom of the node, within this crevice here or here. So it allows us to be very predictive, or at least create multiple scenarios on where we think market price might go that day. And by mapping that out, those scenarios, based on that market structural analysis, we can predetermine how we're going to behave depending on whether it picks scenario 1, 2, or 3. So that's how we roll here. We like to be predictive, not predictive, but aware of where the structure is and where it's likely to go. And when it does, we'll be ready for the appropriate trade. So there we go. And we like to put on our positions in the morning session. And so what I will normally do is just mark off the morning session, which is from 9:30 to 12:30. The first part of the day is typically not the best time to get in. We'll see if we can. And what we're looking for, really, because we're in a downtrend, we'll be looking for a move up into one of these structural elements and then use that as our entry criteria or our entry event. So this morning, you can see that the top and bottom of the node, the top of the node is at 59.75. The bottom is at 59.32. There are other structural elements that are around here. Just take note of them. And so like, for instance, when the market moved down yesterday, you can see it found support right here on this structural element, which is a crevice inside of a low volume node. So the reason I use this color scheme in order to make it easy to identify where the bottom and tops of nodes are. So you can see how I am showing you the green for the bottom of the node and red for the top of the node. So we'll be looking for something like this, where it will come up to the top of this volume node and then move down. Now, when it does that and gives us indication that it has found resistance there, we'll take a trade and put an out-of-the-money fly down below, down here somewhere, right? And we want to make sure that when we place that trade, it has the proper risk to reward so that we can put on an asymmetric trade, and that is coincident with our preservation of capital principle. All right, and once it starts going towards our fly, we will manage that profit with our profit management framework. If it goes against us, then we don't manage that trade anymore. We make sure that the risk is small enough that that is our management. That is our defined risk. All right, so now you get the whole picture. That's our general strategy. If you would like to learn more about trading options on the 0 DTE event, both with indexes, futures, as well as stocks, you can go down below and join our 0 DTE Academy. It's a school environment and incredible. We're actually going to be doing a big market push to introduce the Academy to the world. I already pre-introduced it a couple of weeks ago, and there's already, I think, 75 members there. So check it out. Has lots of resources. You'll have courses on 0 DTE trading, how to become a professional trader, how to control your risk. There will be live weekly events, and even things on how to build up your mental toughness as a trader. So it's a remarkable service for only $35 a month. You'll get the benefit of having a pro trader that's been an institutional trader and hedge fund manager answering your questions. So there you go, 0 DT Academy. All right, that's it. Everybody, Happy New Year. I hope you have a healthy and prosperous New Year for you and your family and your loved ones. And really looking forward. I mean, last year was incredible for us. Thank you very much. Very grateful to all of you. And really looking forward to this coming year. I see a lot of optimism and hope. And with strong conviction, we'll all do very well. Take care. Have a great day. See you next time. Where's that off button? There it is.